Hello, viewers. Welcome to the Alpha Corp podcast, where we help families in reaching their financial goals and building wealth through a structured scientific approach. Um, we have Pratik and myself, Gopesh Mittal, who are your regular hosts on this channel. Today, I'm thrilled to welcome Mr. Saurabh Bansal to our show. Saurabh is an IIT IM alumnus and a SEBI registered investment advisor with over 20 years of experience in both corporate and entrepreneurial settings. He has worked across US, Europe, and India and has a wealth of experience in the financial industry, having been associated with top banks like Credit Suisse and Citibank. Saurabh also founded Finetwork and is a leading investment advisor dedicated to helping individuals and families achieve financial prosperity. Uh, in our conversation today, we are going to cover multiple aspects of building true intergenerational wealth and striking the right balance between risks and returns. As always, this podcast is only for education purposes, and at any point in our discussion today should not be taken as an investment advice. With that, let me welcome Saurabh. We are so happy to have you with us today.
Thank
How
you
are you
so much,
doing?
Gopesh. I'm doing good. Thank you so much for such a wonderful introduction. Really happy to be here.
Great. So, Saurabh, I think these days there's a lot of excitement about Indian capital markets, and there is a general growth in awareness, especially since COVID times, about how people can be thinking about different asset classes. What are the factors to keep in mind, right? So maybe we can start with a little bit of overarching investment scenario in India. What are the typical asset classes available, and what are their risk return profiles? So, what are your thoughts on that?
Yeah. Uh, you know, a lot has changed in India. When
Hmm.
I started Finetwork around 15 years back, um, I don't know if you would believe me. Equity was
Right.
not a easily accepted asset class, right?
Yes. Yes.
It required a lot of persuasion and
Hmm.
convincing.
Hmm.
Um, I mean, most people would not look beyond real estate,
Hmm.
right?
Hmm.
Um, I'm talking about 2010, 11, that time frame. Obviously, it had done very well, in the
Hmm.
last decade or so.
Hmm.
Um, from and FD and gold used to kind of complete the rest
Right.
of the asset allocation. To now, where just things have kind of come completely 180-degree, uh, you know,
Right.
or the opposite end, right? So
Right.
our MFAUM at that time, if I recollect, used to be around 6 lakh crore.
Hmm.
Now it has grown to 60 lakh crores.
Correct. Correct.
Overall DMATs used to be around maybe 1.5 crore or 2 crores.
Hmm.
Now I think the
Hmm.
last statistic I read was around 16
Hmm.
crores or so,
Hmm. Hmm.
right? So people who did not participate, have a sense of missing out on
Hmm.
how this whole transformation has happened.
Hmm.
Um, in terms of options, also, I think there is a lot which has expanded, right?
Hmm.
So, I mean, if you look at equity,
Hmm.
now it's no longer just the listed equity,
Hmm.
right? I
Hmm.
mean, companies which are listed on exchanges, but there are parallel segments which have opened up and they are
Hmm.
flourishing, right?
Hmm.
So, one is the unlisted space, right?
Hmm.
So, startup as an asset class, has also emerged.
Hmm.
Then you have the pre-IPOs,
Hmm.
companies which are about to get listed in maybe
Hmm.
next few months to a year or so, and
Right.
everything in between, right? Mid stage and late stage and all of that. Um, Similarly, foreign equities, I think Indians have also kind of taken
Hmm. Hmm. Yeah.
interest in that, especially with companies, their own employers giving RSUs and ESOPs,
Hmm.
right? This interest around global diversification is also
Hmm.
kind of expanded. Um, so, I mean, equity per se itself, the nuances, the size, everything has expanded, and there are
Right.
lots and lots
Right.
of options which are available. In fact, I feel that on global equity front, the gift city, the
Mm-hmm.
outbound investments through gift city, as and when that comes up, I think that would
Hmm.
also be taken up in a
Hmm.
big way.
Hmm.
Beyond equity, if you look at, say, real estate,
Mm-hmm.
you have, earlier it used to be maybe just buying an apartment or a plot of land.
Right.
But now, again, the entire, you know, plate has got opened up. So you've got commercial offices, you've got co-working space, you've got warehousing,
Hmm.
right? Fractional ownership. So people
Hmm.
have started
Hmm.
to look at various options.
Hmm.
Um, REIT, I think finally in India it has it has come, but I see, it can expand quite a bit,
Hmm. Hmm.
um, and then go beyond the few options which we have at the moment.
Right. Right.
Um, Similarly, on the debt front, again, earlier it was not possible for a retail
Hmm.
investor to actually invest in G6.
Hmm. Hmm.
But with RBI Retail Direct, it has become very easy to
Right.
invest in
Right.
government
Right.
securities.
Right.
P2P,
Hmm.
peer-to-peer lending has
Right.
also come.
Right.
I think I see a smile on your face. Yeah, so some
No, no.
some
So it's just as there's these regulations. So yeah, please continue.
yeah. So we just saw regulations, right, from
Yes.
RBI, which has come, which is good. I mean, if
Yeah.
it's a regulated product, and
Right.
given the way it has grown over the last few years,
Right.
I'm sure RBI would have seen,
Right.
how it should grow, and they have a vision around it.
Right.
But
Right.
as an option, in the fixed income space, it has truly found its way, right,
Hmm. Hmm.
to any
Hmm.
investor's
Hmm.
portfolio.
Hmm.
On the gold front, SGB was a big success, right? I
Hmm.
mean, so
Hmm.
far they've issued close to 44 tons, right?
Right. Right. Right.
And it's again fairly. I mean, when I look at from my time frame perspective, it's a fairly recent entrant, right? I think it
Hmm. Hmm.
would have come in 2013, 14, or something
Hmm.
around that time.
Hmm.
Uh, Even the other two options, gold ETFs and MFs, are also not too old. I think the
Hmm.
gold bees
Hmm.
came in 2007,
Hmm.
and
Hmm.
subsequently, a bunch of gold MFs came along. Uh, so, I mean, this whole space has opened up, right? I mean,
Hmm.
there are
Hmm.
multiple things which an investor can look at.
Right.
Um,
So with all
uh,
these options, we have so many options available right now with the investor.
yeah.
Isn't it that investors are getting confused? Is it that people are saying, okay, let me diversify too much? And is it leading to some suboptimal outcomes because of diversification?
Yeah, yeah, interesting. See, if you look at it fundamentally, there are only five asset classes in the world,
Mm-hmm.
right? I mean, everything else is just a derivative or a nuance of it.
Mm-hmm.
And fundamentally, their risk return profile is
Mm-hmm.
also, kind of derived from their parent asset class,
Mm-hmm.
right? So if you look at equity, it will be up there on the right and top corner,
Mm-hmm.
right? Higher on risk and higher on
Mm-hmm.
return.
Mm-hmm.
Now, within that, you have nuances. So you could have maybe angel investing on one end, and maybe a large blue chip company, listed
Hmm.
company on the other end. But
Hmm. Hmm.
overall, I mean, after all, both of them are kind of representative of equity as an asset class, right? And subsequently followed by, say commodities and real estate. So
Hmm.
I think overall, risk return matrix remain more or less the same.
Mm-hmm.
um, but yeah, I agree. I mean, for an investor who's kind of, it can get overwhelming, right? I mean, how
Hmm.
to place it,
Right.
uh, you know, yeah,
Right. No, I'll bring you back, Saurabh, to this like fundamental mental model that you began to talk about, right? They broadly five asset classes. Could you speak a little bit more about it? How do you structure it around that?
yeah. So fundamentally, right, these five asset classes, you have got equity, you've got
Mm-hmm.
commodity, you've got real estate,
Mm-hmm.
you've got fixed income, and
Mm-hmm.
you've got gold is a floating asset class, so
Mm-hmm.
I'll put it in currency as well as on the commodity side. But
Mm-hmm.
fundamentally, these five, right, and
Mm-hmm.
they are kind of they'll find their place if I could draw a risk return curve.
Hmm. Hmm.
Equity will be on the top far end,
Right.
and maybe short term debt or even currency, right,
Hmm.
is will be the lowest in terms of the risk return.
Right.
um, and within them you can have the variants, right? So as I
Hmm.
said, equity, you have the the a large cap blue chip company
Hmm.
will have far lesser risk as compared
Hmm.
to maybe an early stage startup,
Right.
and maybe something like a late stage or someone pre IPO could be maybe somewhere in between. A micro
Right.
cap would be maybe on the other side, and you know.
Got it. Got it. Makes sense. Makes sense. So as I think about it, right, like when I hear my friends talking about it, equity and mutual funds are the rage these days, right? And kudos to the thinkers behind mutual fund Sahi Hai campaign, that it has really earned a place in everyone's heart, and everybody thinks about SIPs and investing through mutual funds. That definitely is a favorite in terms of newer investors who are entering the markets. I wanted to understand a little bit more around equities versus mutual funds, right? So when I am a person is thinking about to enter investments through pure equities, how to think about the returns which equity offers vis-a-vis mutual funds, and typically I would assume that a person who thinks about equities would want to get higher returns. So how do you make sure, how should one make sure that there's consistent over performance that one can achieve by thinking about equities?
Interesting question, Gopesh. Um, and something which I think people should think about.
Hmm.
Uh, you know, is it equity only, mutual fund only, or a combination?
Hmm.
But before we get there, I kind of wanted to
Yeah, yeah.
share my views on certain beliefs which people have, right?
Sure.
So some people believe that the market is rigged, and individual investor does not have any chance,
Correct.
right? uh, some people believe that even the large fund managers are not able to kind of beat the benchmarks,
Yes.
so where do I stand any
Yes.
chance of doing that?
Yeah.
uh, my personal belief is that an individual investor has certain advantages which a large fund manager does
Hmm.
not have.
Hmm.
um, Actually, that is of size,
Hmm.
right? um, a small investor can get in, get out without thinking about liquidity, without thinking
Hmm.
about impact cost, and
Hmm. Hmm.
the
Hmm.
entries and exits are fairly smooth,
Hmm.
right?
Hmm.
And that gives them tremendous advantage over a fund manager,
Right.
right?
Right. Right.
um, but at the same time, I also don't want to kind of say that it's that easy, right?
Hmm. Hmm.
It would require some commitment and some amount
Hmm.
of discipline to actually benefit
Hmm.
from
Hmm.
equity as an asset class. Um, so
Right.
for instance, people need to have develop some kind of framework,
Right.
right? A framework which they are comfortable with,
Right.
because I think there are different ways of harvesting. I mean, it's an ocean right out there,
Yeah.
so
Yeah.
people can have different frameworks on how they approach it, and it's something which is reflective of their own individual personality,
Hmm. Hmm.
right? But once you do that, I think it's important that you set up some kind of weekly
Hmm.
routine, or
Hmm.
habit of doing certain exercise,
Hmm.
week
Hmm.
on week.
Hmm.
So for instance, I kind of put at least 5 to 6 hours every weekend,
Hmm.
right?
Hmm.
Just to kind of analyze, run my screeners, look at charts, look at data, right? And
Right.
then develop some view about
Hmm.
how
Hmm.
things have gone by, and what are they expected to do.
Right. Right.
uh,
And I think,
so yeah.
sorry, Saurabh, I was saying that one thing that you mentioned, that individual investors actually have an edge over institutional ones. That is very key point actually. I think people do not realize that. People think that, the bigger investors are the ones who will always win, but it's not the case, right? Because the bigger investors will have a lot of cost. If you are exiting with thousands of crores basically, or if you have invested in a mutual fund, exiting a stock from that mutual fund may be quite costly basically. They may move the
Yeah,
market basically, they will not get the price.
yeah, yeah. I mean, that's a huge. I mean, these days there are schemes which are like 40, 50,000 crores.
Right.
So if they have, say 4, 5% allocated to a single stock,
Right.
it's a large sum of money, right?
Right.
It's not
Right.
easy to either build that position or come out of it,
Right.
which an individual investor does not have to think so much
Hmm.
about, right?
Hmm.
Uh, it's like a small boat. It can
Hmm.
kind of find its way
Yeah.
across narrow, shallow, passages
Correct.
as well,
Correct. Correct.
which is a definite advantage.
Correct. Correct. But I think just to summarize my understanding, right? Uh, Although one might feel a little scared when entering the markets, that hey, is there even a chance that retail investor stands? So there is a good chance, but that should be supplemented by regular discipline and adhering to some of the best practices, which you would want to even learn during this conversation today, around what is the right frequency of reevaluation, rebalancing, and that, right? So yeah, that's a very valid point, sort of. Yeah.
Yeah,
Yeah.
yeah. So I think some kind of routine.
Hmm.
What I've noticed, right? People who have
Hmm.
done well or who
Hmm.
do well in the market have a routine, a habit
Hmm.
of spending time, right?
Hmm. Hmm.
And they are kind of up to date on what is happening. You know,
Hmm.
I mean, at the very high level, at the level of Nifty, Sensex, you won't know what is the undercurrent which is playing.
Hmm. Hmm.
Yeah, there is a
Hmm.
sectoral rotation happening. We might be moving
Hmm.
from, high beta to defensive. That
Right.
undertone itself is changing, right?
Right.
And that
Right.
sense you will get only when you are kind of close to the market and running your,
Hmm. Hmm.
routines and going about it.
Hmm. Hmm.
Um, so maybe that's where I think the difference could come, right? Someone who
Hmm.
cannot spend that much,
Hmm.
time and effort to do so,
Hmm.
uh,
Hmm.
for them, mutual fund becomes a logical choice,
Hmm. Hmm. Hmm.
right?
Right.
Because then you are kind of riding on to somebody else's,
Right. Right.
research,
Hmm.
So what could be the,
or yeah, yeah.
sorry, what could be the alternatives to mutual fund, right? For example, somebody wants to have that higher return, let's say higher return compared to market. Let's say they want to beat the market by 10%, 20%, whatever it is, in terms of year on year returns, right? So that at the end of it, basically at the end of 10 years, they are able to accumulate a lot of wealth, which is even better than market, right? So mutual fund could definitely be one way of going about it, but there are limitations like you mentioned. So for investors who want to have that higher return, or basically want to manage risks in the appropriate manner, right? What could be the method to do that? Maybe they don't have time because people are busy, right? People are busy doing their work,
Yeah,
their
yeah.
business and whatnot. People are busy. So what could be the other method?
So they'll have to ride on to somebody else's,
Hmm.
expertise, right? And I think maybe that's where this concept of RIAs and RAs, right?
Hmm.
I
Hmm.
think that's where they find the place that,
Hmm.
you would expect that people who have taken up, this as a full-time profession for themselves,
Hmm.
would be kind of doing that exercise, and you
Right.
can then ride on to their expertise,
Right.
and make sure that you could
Yeah. Yeah.
participate in it.
Yeah.
Can you explain this a little more? Because when I talk to people, right, obviously we are aware about RAs, RIAs, but a lot of people are not aware what is an investment advisor. They think whoever is a mutual fund distributor is an advisor. I We know that's not the case, right? Can you actually explain who is an investment advisor actually?
And just to add to that, right, maybe
Mhm.
tell us a little bit about how the financial advisory landscape evolved over time, and then what are the different categories and what are the different pros and cons, and how to think about different category of advisors. Just as Pratik was saying, there's mutual fund distributors,
Hmm.
there are RIAs, RAs. So that would be very helpful for our audiences.
Yeah, 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 yeah. Yeah, you're right. I mean, I think these words might sound alien to many people because, it's very difficult to
Yeah.
separate, one intermediary from another.
Hmm.
Um, so let's take a step back, right? Historically, advice in India did not exist in isolation,
Hmm.
right? It was part of the product. So
Hmm.
if you needed help, any kind of financial help, you would maybe approach a bank, right, a relationship manager or a broker, right, or maybe an insurance agent, right,
Hmm.
who
Hmm.
who would help you fulfill some aspect of your financial need.
Right.
So usually the advice will kind of come bundled along with the product,
Hmm. Hmm.
right? And you would not need to actually pay them separately because even the compensation is also bundled,
Hmm.
with
Hmm.
the product itself.
Hmm.
But it had challenges, right? Which is
Hmm.
what people realized.
Hmm.
One was that the advice was restricted to that product only, right? It
Hmm.
can't be holistic.
Hmm.
Um, I can't, they will not know the context, they will not know the situation. It would be very limited to that product. The second challenge was, conflict of interest,
Hmm. Hmm.
because what is good for them may not
Hmm.
be good for you, and
Hmm.
vice versa,
Hmm.
right?
Hmm.
So that kind of created the need of separating the advice from the product.
Hmm. Hmm.
Yeah, and that's how the concept of
Just to
advisor
simplify
came.
that point, right? Because I think what you're saying is that if so earlier the advisory ecosystem was inherently tied with the product they were selling. So this was a commission kind of model that they were getting when they sold a product, which limited them in terms of not being able to provide holistic advice, but also their incentives because they were getting commissions. They would probably, not always, push for the product which gives them highest commission rather than what would necessarily be in the best interest of the client. So that is what you meant by conflict of interest, right?
Correct,
Okay.
correct, correct, correct,
Yeah.
correct. Yeah, thank you for clarifying that.
Yeah.
So that kind of created the need for
Mm-hmm.
a new set of intermediaries,
Hmm. Hmm.
who could, bridge this gap.
Hmm. Hmm.
So SEBI, came out with investment advisory regulations
Hmm.
somewhere in
Hmm.
2013.
Hmm.
And they kind of said that for someone to become an advisor, there are set of criteria which they have to meet,
Hmm.
in terms of educational qualification, in terms of net worth, in terms of you have to maintain the kind of the record of advice,
Yes.
um, and you would also be subjected to audit,
Yes.
and things of that sort. So a bunch of things they laid out,
Right.
uh, and the hope was that this as a
Hmm.
trend would pick up and people
Hmm.
will reach out to these set of advisors.
Hmm. Hmm.
And most importantly, you should not get compensated by anyone other than other than the client. So the
Hmm.
product, you can't get anything from the product.
Hmm.
You
Hmm.
have to necessarily get compensated by the client,
Hmm.
right?
Hmm. Hmm.
So at a concept level, it was beautiful. I mean, it kind
Hmm.
of addressed that gap in the market.
Hmm. Hmm.
Um, and you would have imagined that it should have been kind of lapped up
Correct.
by the investors in a big
Yes.
way,
Hmm.
but that did not happen.
Hmm. Hmm.
Any thoughts on what do you think would have been the challenges?
Right. Right. So, so I speak to many people, right, who actually are looking for someone like this, who understand the conflict of interest argument quite well, because most of them have been pitched products by employees of reputed financial institutions who are not able to explain the logic of why they are pitching a product, right? And these are really smart retail investors. So I think the biggest challenge, one, is lack of awareness for sure. That hey, most of the people don't even know that there's something called a SEBI registration, which goes through so many checks and balances that such conflicts of interest should not arise. So I think that is one big part. The second part is also, I think there is a little bit of institutional memory of the Harshad Mehta scams, etc. So many of these investors have started trusting mutual funds because, in their minds, mutual funds are highly regulated. It is something where a lot of people have put in their trust, and it is easier to go by the flow. I think, in terms of trusting advisors, uh, giving them a certain fees and ensuring that our interests are aligned, that is a concept that is still a little bit nascent to Indian investors. And by nature, Indian investors tend to be high ROI, high value seekers. So it is only when there's a little bit of passage of time and then they see success stories is when they will start realizing. So I think those two challenges which might be lying behind why the this model has not seen the successes so far in Indian capital markets. Pratik, would you like to add anything to that?
Sure. What I also think is people are not aware, basically, right? People are aware about mutual fund. They
Hmm.
know that mutual fund takes that 1% commission, right? It
Hmm.
basically goes out of their account. It's not that they're not paying that money. It
Hmm.
goes out of their mutual fund account, basically. It is automatically taken away. Now, in case of advisors, what happens is that they have to pay that 1% fee,
Hmm.
not upfront, but whenever the time passes, right? So they feel that, oh, it is going out of my account, but it's not actually going out of your account. It's
Hmm.
basically the same thing that you are doing. At the same time, the advisors can do much better, basically, compared to a mutual fund, because they can understand your entire life scenario. They can give you advice about, okay, when do you want to take out the money, when do you want to, like, when should you invest the money, right? And also they can think of markets in a very holistic perspective, whether you have a capital of 10 lakh or 10 crores, right? Or whatever is your capital. They can basically understand your capital requirement, and accordingly they can design a scenario through which you can get in and out of the market. So this awareness, I think, is basically missing. And when individuals come in, sometimes people also have that kind of fear that, okay, what if this individual does something wrong? But again, for that, it's not a concern, actually, because ultimately the money stays in the customer's account, right? You are not giving money to an advisor, just like you are giving money to a mutual fund. You are not doing that. The money stays in the person's account. So as and when this awareness becomes better, we would see that the advisory ecosystem grows a lot more people actually approaches advisor. Right now, maybe the advisor has to approach people. It will happen the opposite way also. The people will come and approach advisors, basically. So
yeah,
I foresee those changes happening. It's just that it's early stages. It's like it's been 10 years, but Indian capital markets have been very, very active since 2020 or 21. Right after that, people have come into the market. Now people are not aware. As and when
mm,
people become more aware, I think this kind of scenario will emerge. What you're talking, Kopesh and Saurabh, right? I think that kind of scenario might emerge.
yeah. So, I mean, my sense is that, I mean, there were issues on both the supply and demand side. The demand side, as you rightly said, I mean, I mean, it's paying fees is a psychologically challenging, right? It's much easier if it's kind of taken away, as part
Hmm.
of the expense ratio.
Hmm. Hmm.
Um, so it does cause a sense of friction, right?
Hmm. Hmm.
In terms of doing so. But there's also a challenge on the supply side, right? Because for someone to become an advisor, there's quite a bit of cost and effort involved, right? And even to maintain your license. So the financial incentive to become one
Hmm.
is not there.
Hmm.
So the easier road would be to kind of stick to the
Hmm.
the historical system and stay aligned there.
Hmm.
So I think the demand has to come around and then create incentives for for the supply to catch up.
Hmm. Hmm. Right. 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 Makes sense. Makes sense. True. True. And I think there is also a little bit of the demographic that we have, right? So when you're very young, when you are 18, 20, you actually are more in a DIY model. The capital you're deploying is also a little bit not that high, so you can afford to that take that risk, right? As I think as the demographic becomes more mature, there would be people who would have gone through a couple of cycles, they would have burnt their hands at times, and then they'll probably realize that by the time they hit 30, 35, that it is better for us to work with professionals who would be able to invest their time and have the right expertise to do full justice to the potential that exists. So I think it's a little bit of a maturity of the market and the demographics that would also happen, where over time the traction probably would grow. Yeah.
Correct,
So you talked
correct.
about the demand and the supply, right? In that context, maybe we'll touch upon a little bit of so demand. I think the outlook is that with demographics changes, with systems becoming more mature and awareness growing, the demand should grow in an organic manner. And of course, it would be helped if there's some inorganic boost by associations, etc. Right? Just like mutual funds Sahi Hai campaign, maybe some of those campaigns could also prove their value in terms of the advisory context. But tell us a little bit about what changes are being talked about on the supply side in the light of the recent concept note that SEBI has brought.
Yeah, so I think SEBI is fully aware, of how the registrations have gone about, all
Right.
these years. Uh, so I think they are also maybe slightly disappointed by the
Hmm.
way, how
Hmm.
this has been accepted.
Right.
So they did come out with different consultation papers, and the one which which is kind of under consultation, open for public to give their opinion. This time, I think they have taken a dramatically different
Hmm.
approach.
Hmm.
I think the sense which I get is they really want to expand, right,
Hmm.
and make
Hmm.
sure that it reaches out to more and more number of people. So they've kind of reduced, some of the criteria, diluted some of the
Hmm.
educational criteria, and net worth, and a couple of things,
Hmm.
so that
Hmm.
maybe that could,
Hmm.
help building up the
Hmm.
supply. Um, I mean, it's open, still open. You guys are welcome to give your feedback.
Right.
Uh, but it's a kind of tricky
Hmm.
matter, right? I
Hmm.
mean, you
Hmm.
can't dilute it too much because eventually it's somebody's hard-earned money which is getting
Yeah.
advised upon.
Yeah. Yeah.
Um, and there are retirees, there are people at that stage of life.
Hmm.
For them, there is no coming back,
Hmm.
right?
Hmm.
And also, the impact of advice is not immediately visible,
Hmm.
right? Generally, it becomes evident over,
Hmm.
over a period of time, right?
Hmm. Hmm.
Maybe in a year or two, you get to know how your previous action has actually
Hmm.
played out, right?
Hmm. Hmm.
During the bull market, there's a famous saying: it can hide a lot of things, right?
Hmm. Hmm.
Only when the tide recedes, you can. There's
Correct.
a famous
Correct.
saying around that, right?
Correct.
So the action, the impact of action, the impact of advice becomes visible only over a period of time.
Hmm. Hmm.
So yeah, I mean, that's the fine
Got it.
balance, I
Got it.
think, which
Yeah.
has to be found.
So I think on that note, right, you basically brought up a good point that whenever it's a bull market, a lot of things actually do well. Not that everything does well. Even then, you need an advisor basically to outperform the market, right? But when the times basically become bad, or let's say mid cap suddenly give a big fall, right, or small cap suddenly start going down by 30%, that is when you separate the men from the boys, right? That's a saying that you
Yeah.
separate at that
Yeah.
point. So, from that perspective, what do you think basically from an advisory perspective? You have been running advisory for such a long time. Whenever times become bad, how do you like identify those times, or do you advise investors to exit basically? Like, how do you take some of those strategic decisions?
Mm-hmm. So, as I said, I mean, the impact, I mean, you know, when the market, as you said, say small caps falling 30-40%, uh, you would not be taking the action at that point of time.
Hmm. Hmm.
You would be taking the action 6 months or 1 year in advance, right?
Hmm.
And that's what I meant, that an investor should be close to the market and know what is the current undertone.
Hmm.
And it does not shift immediately. I mean, it
Hmm.
takes time for
Hmm.
for it to do so. If you're on the surface, it might seem very still, right?
Hmm. Hmm.
But inside there are a lot of things which are changing, right? and
Hmm.
and as an advisor or as a good investor, one should be in touch with that.
Hmm.
So how do we do that? We actually kind of follow the techno fundamental approach.
Mm-hmm.
So on the fundamental front, we keep a very close watch on the valuation.
Mm-hmm.
So basically, our view is that there is a price and there is a value, and whenever price goes far too ahead of the value, then
Mm.
then we are kind of getting into
Mm.
a difficult territory, right?
Mm. Mm.
So that's a good time to actually kind of start reducing your allocation to that asset class, right?
Mm. Mm.
Uh, but I think just going by valuation also is not kind of completely perfect, because there are times when you kind of come out maybe a little too early, or
Right.
maybe or maybe a little too late, right?
Mm.
Uh, so to kind of hone it down, we also have some bit of technical
Mm.
approach to it. So
Mm.
we kind of see how moving averages are, how the price is moving against the moving averages.
Mm.
That gives a sense of how things are actually happen on the ground, because there is a famous saying in the market that a market can last longer than you can remain liquid, right? Or
Mm.
something like that, right? So um, you know so a combination of the two actually helps us
Right.
kind of get a better outcome.
Got it. Got it. So on this topic of risk management, right? So there is the return part of it, and then there's a risk management part of it. So maybe we'll delve a little deeper on that, right? So talk us a little bit about how to think about diversification in order to manage risk better.
Hmm. Hmm. So I think the interesting thing is that all of us know that diversification, asset allocation, position sizing, these are important, right? To kind of manage risk.
Hmm. Hmm.
I think the challenge is in terms of sticking to it,
Hmm. Hmm.
right? When you are actually practicing it, that's when it gets a little challenging.
Hmm. Hmm.
So you know, uh, diversification or asset allocation by nature means that you will have a portfolio in
Hmm.
which some things will be doing well and some things may not be doing so well, and
Hmm.
that is by design,
Hmm. Hmm.
right? That is by design.
Hmm.
Uh, but what happens is that when you are evaluating that
Hmm.
overall,
Hmm.
right, your mind, the attention will go to the piece which are not doing well,
Hmm. Hmm.
and you would want to start thinking कि यार इसको रखना है नहीं रखना
Correct. Correct.
है, right?
What am I missing
Um,
out?
yeah, I mean, I could have been better off if everything
Yes.
I had was in the well-performing ones, right?
Correct. Correct.
Um, and I kind of witness it very closely. Many of our
Hmm.
clients kind of come up and they say कि
Hmm.
यार ये debt और gold इतना अच्छा नहीं कर रहा है, ये equity इतना अच्छा कर रहा है, so why to have them, right?
Right. Right.
Uh, and I mean, if you kind of come to think of it,
Hmm.
a car में जो airbags होते हैं,
Hmm.
they are rarely deployed,
Hmm.
right? Uh, but you would still need them, right? I mean, you might pay a little bit extra to have that feature in your
Yes.
car,
Yes.
right? It gives it the safety, gives it
Hmm.
that sense of comfort
Hmm.
while
Hmm.
driving that.
Hmm.
Um, Similarly, as an advisor also, or I'm sure it must be true for fund manager as well, there is a pressure of underperformance.
Hmm.
So, because you are getting judged on that, so you will also have a tendency to kind of have the tilt
Hmm.
a little more towards the
Hmm.
a better performing asset class,
Hmm. Hmm.
right?
Hmm. Hmm.
So I think there is an obsession with XIRR,
Hmm. Hmm.
and everything gets judged on the XIRR.
Hmm.
So I think as a society, as an industry, we have to kind of find a way to take the attention away, or at least get risk parameters also get the same amount of attention, right?
Yeah.
Have
Yeah.
some equivalent on the risk side, which gives you a sense that
Yeah.
you're kind of taking on more risk with this change.
Right. I really love this point, right? And I want to dig a little deeper so that people who are more diligent and who really want to work on this aspect, right? So the concepts such as efficient frontiers, where you know that, hey, this kind of return, this kind of risk is justified. So for an investor who is largely layman, but probably willing to put in that effort, right? What are some of the metrics? What are some of the easy ways to understand that, hey, this kind of return is efficient looking at your risk appetite? So how do you quantify the risk angle, and I'm sure there are pretty much many tools to do that. What are some of the easiest tools to get started with to understand the risk side better?
I think studying the historical data is
Mm-hmm.
the best way, right?
Mm-hmm.
Um, if you kind of look at, like I said, right? I mean, if you just study the price versus the value, and
Mm.
that value, people get hung up on, oh, should I look at earnings? Should I look at sales? Should I look at book value? I'm saying
Mm.
don't get hung up on that, but just study that historically,
Mm. Mm.
how the two have kind of gone along.
Mm.
And you would notice that whenever price goes far too ahead, that's a time to actually, that's when
Mm.
the risk has started to become really strong,
Right.
right?
Right.
And but it's like a song of siren. I mean, no matter what you do,
Right.
it will it will tempt you, it will
Right.
get you in that direction.
Right.
I
Right.
remember 2018. Pratik, you were talking about mid and small cap. 2018, there was a big correction. 18 and
Mm.
19, there was a big correction which happened in mid and small cap. But you should ask people who were there in 2017. People wanted to really load up mid and small cap
Mm.
because they had given such a great outperformance over the large caps, and it has happened across the time, right? I remember 2021. People wanted to invest in Nasdaq, and then we saw what happened in 2022. Um, and over time it has happened. I mean, even if you go before that, in 2000 everybody wanted to be in technology and IT, and then we saw underperformance over the next 3-4 years. In fact, Nasdaq took some 10 years to get back to the same
Mm.
level it had achieved in 2000. I think
Right.
2010 is when it achieved that. Similar in 2007-8, there was a craze around
Right.
infrastructure and real estate,
Right.
and a long period of time had to pass and do that.
Right.
So just to kind of understand that, Daniel Kahneman talks about, you have got two brains, right?
Brains. Yes.
System A, system B, right? So be
Yeah.
aware of that and the conflict which is playing out between the two.
Yeah, a brilliant analogy. But while we are at that, right, uh, FNO is another exciting thing, right? And for serious investors who are actually not that aware, might have a little bit of negative connotation that gets associated with FNO, that it's pure speculation. I would like to get your take on the hedging aspects, the risk mitigation, balancing aspects of FNO, and if you could elaborate on the cost benefits, and how should a serious investor think about using FNO as a way to manage risk?
Actually, FNO came into existence, derivative came into existence with the purpose of hedging,
Yes.
right? But by its very nature, it kind of, it became speculative, and that's
Hmm.
where, I think the negativity started to
Hmm.
get associated with it.
Hmm.
But
Hmm.
essentially, it came into existence to protect, right?
Correct.
If you've taken a position in a certain way and you want to protect yourself, against any whatever unforeseen circumstance, you
Hmm.
could take a reverse position,
Hmm.
right, on the FNO front for a
Hmm.
for a marginal cost,
Hmm.
right?
Hmm.
Um, Now, for a normal, I think retail investor, um, my sense is that I think asset allocation and position sizing should do the trick. I
Hmm.
think that
Hmm.
should be enough to kind of create, do the risk management in their portfolio.
Hmm.
Um because it comes with a cost, right? I mean, I think it would easily add 2 to 3%
Hmm.
overall in your portfolio.
Hmm. Hmm.
Uh, but for investors who have got very unique positions where they can't dilute it,
Hmm.
or they want to hold on to it for whatever reason, for
Hmm.
taxation or any of those reasons, I think
Hmm.
this provides a good opportunity. There are some challenges though. I mean, if you look at it at the moment, we have got only Nifty and Bank Nifty,
Right. Serious
which
volumes are
is
there. Yeah.
volumes are there.
Yeah.
Beyond that, it's kind of a little shaky, right?
Hmm.
So you can't have a complete hedge, but at least some sense of protection comes along if you don't
Got it.
want to liquidate your positions.
Got it. So that's very helpful. You're saying it's around 2 to 3% of costs. If you're willing to take that cost to maintain a certain positions driven by certain taxation or some other constraints, that is the kind of cost you would need to pay. But at the same time, you will be able to manage your risk and volatility better. Got it. Got it.
Correct.
Correct. But in terms of, let's say, an investor who is really looking at derivatives basically because they have to do a hedging. So, what kind of suggestion do you actually give to them? Do you say them that, okay, buy a protective put, or do you just go and short a call so that there is some time value that you can actually extract out of that call?
Yeah, now we're kind of getting into very technicals. Uh, you know, if a big correction has to come, your short call is not going to protect you much,
Right.
right? Short call is still a income generating approach rather than a pure
Hmm.
protection approach.
Hmm.
For protection, what a put will give you, I think that's incomparable, right? Uh, I mean, a small, a small change in prices, short call, can help you to some extent. But I don't think, yeah, for a situation like COVID, which is what you would want to protect yourself against, I think you need to have certain, puts in place,
Hmm.
and you'll have to bear the cost for doing so.
Got it. A
Right.
little bit of future gazing. 25 bips, 50 bips. What do you think? What's the view on Fed rate cuts in the few weeks from now, and how would that likely impact Indian markets?
Yeah. I mean, this is something which I've kind of stopped speculating on. Central banks. That's and they've surprised people enough, right,
Right,
with
right.
their actions. So, to stay surprised is, I think, the best approach. With Fed. Having said that, I think we have come to a stage where uh, the interest rates have been high for
Mm-hmm.
substantially high for a fairly long time. So
Hmm. Hmm.
maybe I think we're getting there.
Hmm.
Um, Historically, emerging markets have benefited from the
Hmm.
the rate cuts. Uh, but India in particular, we are trading at a very high valuation,
Yeah, yeah,
vis-a-vis
yeah,
rest of the world.
yeah.
So I don't know to what extent that flow, if it comes, will come to
Right,
India.
right.
Uh, but I don't think it's going to be a very smooth journey. There are
Hmm.
many more variables, right? There's also
Hmm.
US presidential election, which is
Hmm.
also kind of coming.
Hmm.
So there will be volatility, is what my sense is. Even if you look at it historically, when they start cutting rates, it's not immediately the impact would be
Hmm.
visible. The market takes a
Hmm.
while before kind of respond to it.
Reacting to it. Hmm.
Uh, yeah, but it would be interesting. I think in US, most of the recovery had come through the tech stocks, right? The big tech.
Hmm.
Rest of
Hmm.
the market is still struggling,
Hmm.
right? They are mid and small caps. The broader real economy had been struggling. So hopefully
Hmm.
that should benefit, from the rate cuts.
Got it. Got it. Changing the gears a little bit to other asset classes, right? Talk to us about how should an Indian investor think about gold as an investment? And you talked about ETFs, SGBs, and mutual funds. How should we look at gold in terms of beating inflation, balancing the risk and volatility of the portfolio? So, how should someone think about gold?
It's a very interesting asset class,
Hmm.
and something which I think our previous generation also were very clearly aware of, right? I mean, it's so inbuilt in our culture that, in fact, there's a festival also around that, right?
Yeah, yeah.
Around gold.
It's a
Akshay,
mandatory. You have to buy gold on that day, just a few days before Diwali. Yeah, so yeah.
yeah, yeah. So I think it's a universal currency.
Hmm.
It's a ultimate defense against the economic mismanagement
Right,
of their own government,
right.
right? So I mean, it's a very important asset class. I mean,
Hmm.
if the world has to get destroyed and we have to rebuild it again, I think
Right.
gold gold would be the common
Still hold the
denominator at
value.
which,
Yeah.
yeah, and we're going to begin on, start
Right.
building on top of it.
Right.
And time, time over time, it has shown,
Hmm.
how it has done well. You look back and just see how equity and gold have done, right? It's a natural hedge against each other, right? So during bad times, gold. Uh, you look at 2008, look at 2020, 2000, especially since we've kind of gotten into this world of fiat currency. I think the importance of gold is I mean, it's a critical part of the portfolio. So even if even if it's not doing well, I think it's going back to our previous discussion. I think it's really important to hold some portion in gold.
Hmm. So for someone who does not really want to spend time, sort of an index investor, investment kind of person, would you recommend something like Nifty plus gold kind of portfolio to get returns as well as manage volatility?
Yeah, I think it's a very good combination. Uh, Nifty plus gold, are like, brothers,
Hmm. Hmm.
and very different profile
Hmm.
to each other. You would
Hmm.
not compromise also too much on the
Hmm.
return,
Hmm. Hmm.
right? But the correlation between the two kind of creates a
Right.
natural hedge.
Hmm.
Uh,
Got it.
Okay.
Got it.
On that note, basically, there are other asset classes. For example, we have real estate as an asset class, right? Nowadays, in Indian cities, it is very expensive to buy real estate, right? So, whenever people are allocating something into real estate, it is likely to be very significant portion of the portfolio for them. If even if somebody is buying their own house, even then, most of the savings or most of the investments will basically go into that kind of an asset class. So how do you think of that, and how do you think of real estate as an asset class itself? Let's say even if somebody has some spare money and they want to invest, should they invest in real estate or should they just restrict themselves to gold and equity? How do you think about it?
so, real estate for consumption and real estate for investment, I think we should separate the two, right?
Hmm.
For consumption, it's just like buying a car, right? I mean, it's a personal asset. There are emotions involved. You would not think so much,
Hmm.
in terms of what kind of returns it would generate and
Hmm.
things of that sort. So let's just put it aside and just focus real estate as an investment, from the investment perspective. I think, I mean, it is one of those five fundamental asset classes, right? So I think it's a important asset class. It's just that the nature of asset class is different, right?
Hmm.
So the cycles of real estate are longer than the cycles of equity, right? I mean,
Hmm.
if you look at the frequency, the real estate cycles last longer
Hmm.
than the equity one.
Hmm.
Um, the second is, leveraging is possible, right? I mean, there is an incentive, right, which
Hmm.
is available, and you could really, leverage making an investment in real estate.
Hmm.
Uh, a third thing is, I think in terms of yield, the kind of yield real estate generates, you can't expect it from any other asset class to generate that kind of yield, right? Yield
Hmm.
plus appreciations, right? So if you kind of
Hmm.
put it together, so it's a good asset class from income generation perspective as well, right?
Hmm. Hmm.
But there are challenges. I mean, liquidity is a challenge. I've got many clients who are sitting on real estate. They're not able to sell.
Hmm.
Um, in India, I don't know. Somehow feel the Indian real estate market is very different from the rest of the world.
Hmm.
Do you have any thoughts? You lived in US, Kopesh.
Actually, I don't because I was not looking at staying abroad from a long-term perspective, so never thought of putting down my roots
Hmm.
and acquiring some real estate. But very curious to know what are the differences that you see in terms of real estate in India versus US.
So if you look at the rental yield versus the interest rate,
Hmm. Hmm.
or rather say the EMI which you pay versus the rent
Hmm.
which you could get.
Hmm.
I think it's India is the only country where there's such a huge difference which
Yeah.
exists between the
Yeah.
two,
Yeah.
right?
True. True.
Um, I mean, rest of the world they are much closer.
Hmm.
Um, so somehow something has to give way,
Hmm.
right?
Hmm.
Um, Either the price has to give way or the yield has to give way or the interest has to give way. I don't know what will happen.
Hmm.
Um, so in that sense, Indian real estate market is a little kind of a black box.
Hmm.
And I'm talking about the broader one, not
Hmm.
the upcoming one. Upcoming ones are interesting, right? So,
Hmm.
as I said, I mean, yeah, commercial office space, the warehousing, co-working,
Hmm.
all of that,
Hmm.
they're pretty interesting.
Right. And if somebody wants to get exposure to some of these things, right? For example, co-working, you mentioned, warehousing, even other avenues, commercial. So, what are some of the best and the easiest way for a retail investors to get exposure to?
Yeah, so I mean, uh, the regulations around that are still evolving, right? So other than REIT, you are kind of other
Hmm.
than that, you have to kind of go beyond the
Hmm.
regulated space.
Hmm.
REIT is completely well regulated, so
Hmm.
that that we are kind of clear about, right? And
Hmm.
that's a nice way to actually take exposure. But
Hmm.
beyond that, basically fractional ownership is what the model which I see is the most
Hmm.
common one.
Hmm.
There are companies, who are there in this space, who
Hmm.
have created, products
Hmm.
in which one can participate, and then,
Hmm.
multiple people come together and kind of,
Got it.
participate in that.
Got it. Cool. So I'm also looking at the clock. We have a few minutes left. Uh, I can't leave this conversation without bringing the most hyped topic these days, which is AI, Gen AI, Chat GPTs, and artificial intelligence. So, from your perspective, Saurabh, how do you see this impacting the investment and the advisory landscape? Would there be smarter ways of managing risk and rewards? Can you make better returns with lesser risk? So, how do you see this playing out both in the short term and in the long term?
Interesting question. Uh, See, the market functions on supply and demand,
Hmm.
right? I'm not very sure if the if both the sides are equipped with AI,
Hmm.
will it fundamentally change the nature of the market,
Hmm.
right? Um, that I doubt will happen. So I
Hmm.
don't think you can create something where there is low risk or zero risk and there's
Hmm.
very high return,
Hmm.
um, because both the sites will be equipped with with,
Hmm.
with the same.
Hmm. Hmm.
Uh, I think maybe the shorter time frame, right? That's
Hmm.
where maybe the AI will kind of start to take over. The machines will, and they have already started to take over in some way.
Hmm.
So shorter time frame, it's difficult for humans to kind of find a place for
Hmm.
themselves.
Hmm.
But in the larger scheme of things, in terms of
Hmm.
strategic thinking and decision making,
Hmm.
my sense is human beings will continue to
Hmm.
kind of be the one leading that.
Right.
Um,
Right.
but that's my belief. What are your thoughts on that?
Right. So I think when you said short term, you were referring to the high frequency trading and how there the role of technology and how fast decision making can capture some of those arbitrage, minute differences and take advantage of that. And I think that is beginning. I mean that has been around for some time actually, and that has shown promise. But then at some point of time, that also starts getting saturated because pretty much technology is democratic in some ways. So yes, I think the interesting play would be in the long term, wherein on one hand, fundamentally, both sides would have the same access to tools, but maybe there would be newer models of advisory around robo advisory, which might start getting traction. Personally, I think. I look at advisory model as akin to that of a doctor model. Uh, Whatever happens, whenever there's a serious amount of money involved, I need someone like a human being, an expert who understands the complicated nuances and like the illogical considerations which only human beings can understand, right? Like somehow, if I need to go surgery, I'll always prefer it to be done by a human expert. And I think that would play a big role in how this evolves, and it would always be an interplay. So I think on the bottom of the pyramid side there would gradually be some kind of advisory which is close to free, which might be determined for lower AUM amounts driven purely by technology. But I think for serious considerations or serious strategic calls, I think it would still be human driven largely. So yeah, that's how I think about it.
Yeah,
Yeah,
yeah. Pratik,
yeah.
you have any thoughts?
So, I mean, I have been watching this thing from a very close standpoint, basically.
Hmm.
In fact, the way it's not so much about chat gpt, really. It's about the older AI, right? Because chat gpt can only do so much. What it can do is it can basically summarize something. It can take the information from the market. Maybe it can take the Twitter sentiments and summarize that sentiment. That's all it can do, right? But the older AI technologies which were actually available even before chat gpt, those are the things that can potentially have a lot of value to the advisory system, basically. Like, maybe the advisors can reduce the amount of time they actually spend to analyze a stock by using some of those technology. The neural networks are probably getting very smart, and I think that is where maybe advisors can play a role. Advisors will still be there, which means advisor is still advising the person, but at the same time maybe advisors can utilize some of those technologies to make benefits for the clients.
Hmm. Hmm.
So it is going to assist, it can never replace.
Hmm.
Yeah, very nice.
Nice.
Very
Nice.
nice. Cool. I think with that, I'll probably wrap this conversation up. Thanks a lot, Saurabh, for joining the conversation. This was very enlightening, and I hope all of us took some precious insights from this, and will work towards diligently reviewing our portfolios and incorporating some of the best practices around what returns to expect and how to manage our risks. So, thanks again. We'll wrap the conversation here.
Thank you so much to both of you for organizing this, asking such interesting questions. So really enjoyed our conversation.
Thank
Thank
you.
you.
Goodbye.